Good morning, everyone. Thank you for joining me on this small mutual fund session. So today in this workshop, it's more like a workshop, not so there will be a small presentation in the beginning. Uh, we'll discuss the key points in brief, and then we'll look at the case, and we can take up the real scenarios, real life scenarios after that. So we are covering retirement as a financial goal. Retirement is one of the biggest goals, so that's why we have chosen this topic. And then we'll look at the key points in retirement as a financial goal, and then investment options that you have in India for retirement, and then how do you invest for retirement, and your investment risk profile, how does that affect your portfolio, then retirement plan, this will be case study, and then we'll be open to questions. So, retirement as a financial goal consists of there are three phases. In the first phase, when you are working, you're contributing small amounts regularly, and that builds up a corpus for you over a period of time. After 10 to 20 years that you have built the corpus, you let the corpus grow. That is the second phase. And then in the third phase, which is post retirement, you want to generate income out of the corpus that you have accumulated. These investments and choice of mutual funds will can be different in all the three stages. So that's why this classification is important. In the middle of the presentation, if you have any questions, you can raise your hands or just drop a message in the chat. I will try to take the questions as they come. There is no need to wait for the question or it's an open workshop. So let's continue from here. And so, how do we divide? Generally, phase one is between 24 to 40 years, and phase two you can start after 40 anytime, and between 55. So after 55, you are more worried about the distribution, like how will you generate income out of the money that you have accumulated over the years. So in first phase, you are more concerned about uh, growing your small investments. So you take more risk. Your risk appetite is also high, so you can take more risk, invest in equities, mutual funds, equity mutual funds, and but your investments are small, so you have to be consistent and recurring uh, investments have to be there. In phase two, you have a lump sum amount which you can invest. So investing for a large sum of amount opens up a lot more different opportunities for you. So that's why phase two, although it's you can understand if you are salaried in phase two, also you will be continuing to contribute regularly. But in phase two, you have a big corpus at your hand which you want to invest for phase in preparation of phase three. So slightly different from phase one. And before, so that was about the investment styles and the phases of investment. But ultimately, it all has to relate to your real life, and this is where it comes to. So, what exactly your objective is? So, you want the needs to be fulfilled first, and then you have certain wants like second house, uh, traveling around the world, or traveling around the country regularly. Some people also trade, so that there is a small percentage of you would like to trade in the stock market after you retire as a pastime. But if it comes to where you can compromise and where you cannot compromise, so you cannot compromise on the needs. You need household expenses, living cost, healthcare, and uh, somewhat also for gifting purposes because family and grandchildren will expect something out of it. So we compromise on wants if we have to. Otherwise, we'll take care of both the things with our retirement savings. So when we look at numbers, you will understand why you might want to or have to compromise on certain things when you prepare for the retirement. So coming to the investment options, any questions so far? Okay. So the investment options, we have lot of investment options for retirement. Some of them are fixed income options like provident funds, and then there is aggressive investment options like national pension scheme, mutual funds, obviously, and unit linked insurance plans. Equity stocks are also there, which are becoming popular nowadays. Exchange traded funds are there, real estate investment trusts are there, and if you have lot of money like 25 lakhs, a corpus of 25 lakhs minimum, you can also go for portfolio management service. And then there are pension plans. So all these investment options will come in handy in different stages of your retirement planning. So this is how we distribute. You generally distribute in according to the phase you are into. So in the phase one, we'll try to allocate more into equity mutual funds, gold, ETFs, stocks, NPS, and ULIPs, because these instruments give you exposure to the equity market, and you also have time at your hand. So you can let your money grow over a long period of time, like 5 to 10 years minimum. And then in phase two, we focus on safer but still high growth opportunity options like hybrid funds, REITs. REITs basically invest into real estate. They are alternative to investing in commercial and residential real estates. Pension fund, you can at the end of phase two, you can start investing in pension funds. Some of these pension funds also invest in equity. They give you a small exposure to equity. So in phase two, you can start that also. That are giving income to you. And before we go into types of mutual funds, any questions on the risk profile? Okay. I think this theoretical thing is pretty boring, so let's quickly move on to the case, and that should give us more food for thought. So, just in brief, mutual funds there are multiple, several types of mutual funds. In fact, there are more than 15 different classifications, formal classifications that SEBI has provided. But you can classify mutual funds based on couple of different things. Like if there is you can classify them based on the assets they are investing into. So some mutual funds will invest in only equity, only blue chip stocks, so you can have that kind of mutual fund. Then there are diversified mutual funds which are investing in diversified debt mutual funds which are investing in gilt and corporate debt instruments. Then there is only gilt fund which is investing in only government securities. So mid cap index fund, and then there are you can classify them as objective. So what their investment objective is. If they want to generate income, they will be investing in dividend yielding stocks or uh, coupon paying bonds. Then there are sector thematic funds which are focusing on certain sectors. So if some of these funds will be focusing on FMCG, other pharma, and so on and so forth. Then there is a category called ELSS, which had been popular because of tax savings uh, under ATC, but nowadays with the new tax regime, ELSS is also not a necessary tool to save tax. But still, it's a different theme of investment, different objective. So ELSS is there. Then some lot of equity funds and debt funds will have growth options and income options. So you can choose one of these. Then there is a capital protection fund also. So they will protect a minimum 70-80% of your capital from loss while trying to generate growth. And then there can be investment style differences. So if you understand, so the idea is to invest in a fund that you understand and that fits well into your risk category, investment risk profile. So a lot of these funds, and in the whole universe of the funds, every corner of the risk return profile has been filled by certain funds. The more specialized a fund is, the riskier it is in general. So if I talk about, let's say, duration oriented funds are usually debt funds. So based on the duration they are targeting, they can be risky. The longer the duration, usually the riskier the fund is, and the shorter the duration, the lower the fund risk, lower the investment risk in the fund. Similarly, contra funds are considered highly risky, sector funds are considered high risky, but in that same asset, and they are all in the same asset class. And then there are FMPs. So before you can start investing, you need to you need to have a investment risk profiling done, and that investment risk profiling, as we saw, will be based on those factors and a couple of more based on individual scenarios. Okay. Any questions so far? And let's jump into the case. My screen is visible to everyone. Great. So, okay. So in this case, I've taken a case of a family with 2 children, and so these goals are nothing out of the there are no extraordinary goals here. These are pretty normal for almost all of you will have these kind of goals if you have a family. So if you see retirement is mentioned as a separate goal, the cost of retirement is generally your monthly expense. That's what you want to fill, want to provide your family or yourself with when you retire. So I'm assuming the assumption here is the investor is 30 years old. So considering the retirement age at 60, he has 30 years to accumulate uh, enough corpus to provide the same lifestyle that he has right now. for the family. Now, one of the biggest, so calculating these numbers is not a very difficult task. Anybody can do it. In fact, you can have access to these calculators. They're online, freely available. You can calculate all the costs. The major problem is when you try to assess which expenses to consider and which expenses to discard for the retirement. So that is the problem of a financial planner. That's why you need them. And after all that exercise, that is the majority of the work. After all that exercise, you arrive at a number. Okay, I'm spending 1 lakh per month right now, and I consider, okay, this takes care of my healthcare expenses, my household expenses, rentals, subscriptions that are necessary, like insurance and all. And then this is what I want to replicate at retirement. So even if your expenses are growing, which is because these are household expenses, these are essential expenses majorly. So the inflation rate remains slightly lower than the other uh, expenses like education cost and marriage and everything. So considering it at 5%, in 30 years you will need 4 lakh, 4.5 lakh rupees a month to sustain the same lifestyle. Now, with this 4.5 lakh, how so you need a corpus at the age of 60 that can sustain this number, that can sustainably provide you with this amount every month until uh, your final days. And whatever the corpus that will be left can be left to the legal heirs or as a estate to your children or grandchildren. Now, the calculation, if you look at pretty simple numbers, you are 30, retire, you would want to retire at 60, but the scenarios are changing, and we'll discuss that as well. So, and in ideal scenario, if you work till 60 and then you retire at that age, you will have 30 years, and your life expectancy is 95 years. You will have another 35 years to live after retirement. Expected inflation right now, I'm assuming 7%. It can be different and changed. And I have taken a risk profile as a high risk. Investor's risk profile is a pretty aggressive high risk profile. And why this is high risk is you can see with the cash flow that this guy has salary income and a rental income. So he's pretty safe. So he can his occupation is pretty safe. He has a fixed income. He's pretty educated. He can continue working till 60. So we are assuming he can take a high risk allocation for assets. And for 30 years, he can go for maximum risk. So most of the investments will be in equity and gold for now. So the rate of return that I'm assuming is 13, somewhere in ballpark of 13.5% per annum. And post-retirement rate, this also can keeps on changing. We expect, in general, the economic perspective is in the long run, the interest rates will go down, and they have as per the past, but the trend is slowing down. So, like till 2011, 12, you could have an FD which would pay you 14, 15%. But now you don't find those kind of fixed deposit anymore. You have fixed deposit which are paying you at least at most 8%, or in some ideal scenarios 9.5%. But so going forward, this will only come down, and we are expecting 4.32 lakhs per month after retirement. And current savings I'm taking at 10 lakh rupees. So if you are and 8.5%, so you need 17 crores at 60 to give yourself 4.32 lakhs per month till 95 years of age. So there are two ways you can start investing in investing to build this kind of corpus. So let me take a pause here. And any questions on the scenario? Do you understand the scenario, or should I change or repeat anything? So if you want to manage the lifestyle that you have at current 1 lakh rupees per month expenses at the age of 60, and if you're 30, you will need approximately 4 lakh rupees per month. And to get 4 lakh rupees per month at 7.5%, if you can invest your money at 7.5% post tax, so you will need 17 crore or almost 18 crore rupees at 60. And how much do you need to invest every month to build this corpus? If you are 30, you just need to invest 42,000 per month. This is a fixed amount. I'm not expecting any growth, but if you are expecting to increase your savings every month as your income grows, so assuming that your income is going to increase by 10% every year, and if you can continue increasing your contribution to your retirement by that same percentage, you can start with 19,000 rupees. And this is SIP. So where is this SIP going to? This is going to equity funds and gold funds or gold ETF. Or you can also tell your financial advisor that I am going to invest 50,000 rupees in my towards my retirement. So that will give you a scenario. Okay, you just need 12.8%. Now this return is not important. What is important is if you can invest more than what is required, you can stop investing after a short while, and you can take a break and let the money grow. How does that work? Is you have multiple goals. So if I look at cost of goals, you have uh, retirement is ninth goal in the list. You have 8 other things to do. In this case, this is not second home or second home. This is third home because he already has a second home. So he's targeting for that because his cash flow shows that he can have adequate savings that allows all these goals to be fulfilled. Now, if I go to, so also he already has a lot of savings available. So we need to allocate all those savings from the net worth sheet. If you can see this, so there is FD, there is equity mutual funds, there is ELSS, there are stocks. So all these assets you can allocate to different goals and help these and get these goals cover up for themselves within the timeline that is provided. Retirement is also you can, so once you allocate all these necessary goals like child's education and marriage, and then you will have to replace your car after 10-15 years, so assuming just 5 years most of the time. So nowadays what is happening is you need to plan your retirement, your two retirements. One is your normal retirement, which is at the age of 60 if everything goes well and you may remain relevant for your profession. Am I audible to everyone? Oh, I think this is a signal issue. Okay, so all right. So let me repeat from. So what we are talking about is, okay, retirement is one of the biggest goals, yes, but there are other goals also. So all these other goals, and you have, if you have assets currently in your portfolio, you can allocate those assets to all the important goals, and then also to retirement goals. So if you are salaried, and so nowadays we are talking about the scenarios nowadays. What is happening is a lot of people are finding that after 45, or we recently saw a lot of layoffs from the software industry, which was one of the highest paying jobs at one point of time, like 10 years ago. That was a hot industry. Right now it's in maturing phase, and there are a lot of changes that are happening. People are finding that after 45 you're not no longer relevant with your current skills, so you need to either upgrade or change the industry. Maybe you don't want to continue doing the same thing, you want to do something else. So you also need to prepare for that second retirement before you actually retire from the in the ideal scenario. So before 60 you are retiring at 45, 40, or a lot of people are getting into startups, starting their own ventures. So that becomes your second retirement planning also. So you have a business corpus goal which you want to address, want to have in your financial plan. So in this case, we are planning, okay, after 10 years, you can invest, at least you have equivalent of for 25 lakh rupees after 10 years from now, that you can invest in your own venture, to start your own venture, if you don't want to continue doing the same thing that you are doing right now. So that is going to increase your investment burden. So right now we don't see that. So in this existing allocation, I don't see that how much investment. I've not allocated the assets right now. So what we can do quickly, we can start allocating these assets. One of the things we need to see is the real cost of gold. So in the first goal, we require 19 lakhs, and we are 10 years away. So let's see if we can allocate this, and assume a 10%. This is equity for 10 years, uh, assuming a conservative 10% per annum rate of return, we'll have 12 lakhs. For the marriage, let's allocate something. Okay, so we allocate 15 lakhs. Again, assuming 10% only, we'll have 46 lakhs, which is more than enough to take care of this goal. And then you see, most of this investment for this person is into equity, so it's getting. So this is mostly gold. Gold has so for last 5 years, gold's return on gold has been pretty high, but we are taking conservative 8% only. In last 5 years, the return has been around same as equity, like 12, 13%. So for car, goal is pretty close. So we'll take something from here, assuming a 5% post-tax return. This will be adequate to fulfill the car goal. And then there is business corpus. Let's see if something is left. Oh, there is PPF. This will go to retirement only. Second house property, you don't generally allocate a property to any of the goals unless, but you can allocate the income that you have from the property to the goals. So that will be the idea. And then so for this, these two we leave out. We can start looking at the final numbers. So you see, a child one's marriage goal was completely fulfilled, and there is even surplus from that. So the SIPs are coming into negative. But in total, if you look at, you just need to invest 32. This guy just need to invest 32,000. Or if we remove the negative amounts, so this is okay. So removing all the negatives, which where the goal is already fulfilled, you don't need any SIPs there. This guy just need 80,000 per month to fulfill all the goals. But that is mostly because there are a lot of assets already in the portfolio. So even with the assets worth more than 1.5 crores, this guy needs an SIP of about 80,000, slightly less because two of the goals have been already fulfilled and there will be surplus from these goals which can be allocated to fulfill other things. So this guy is in a pretty good situation. So compared to this, you can look at your portfolio and see where you stand. This is the cash flow plan for the next 30 years for this person from starting from 2015. In fact, this is only 20 years plan, so we can extrapolate it to 30 years. So we planned for 50 years of retirement. So you can we can change this and we can see now you need 21 crores. And now if you look at the investment portfolio, uh, okay, so 80,000 is required to fulfill all the other goals. For retirement, you will need additional 1 lakh rupees on a minimum or 2 lakhs maximum on fixed rate. So, any questions, any change in the scenario, any suggestions for the scenario to anything you want to see? Uh, Please type in chat if you can. Let's see if I can. So anything, any change in the scenario you want to see, if you want to calculate your own retirement goal, we can do that also. So instead of 50, if let's say if you are 40 and still want to retire at 60, and we are planning it today, you see the scenarios keep on changing. Now you just, although the difference is only 20 years, the corpus that you need is still is just 17 lakhs now. Sorry, 17 crores, and then you need 85,000. It's because at the age of after the 60, you just need this much money. So let's go to this and change this to 20 years. So right now you have 1 lakh rupees of expenses, and you just need 265,000 per month. You will need a corpus of only 10 crores. But if you retire 10 years further than this, when this guy will be 70, and you are, if you are 30, you're retiring at 60. If you are 30 right now, you will retire 10 years later than this guy, and you will need 17 crores instead of this much to maintain the same lifestyle that this guy is maintaining. And but he will be able to do it in just 11 crore rupees, and you will need almost 17 crores to fulfill the same thing. So please suggest any changes. This is all from my side, and my name is Narayan. I am a mutual fund advisor, and I am Lucknow alumni, uh, and preparing for financial planning services also. That's a So all the things combined, you just saw what can be done. So none of this. So whatever we are discussing here is a general scenario. So let me put this disclaimer out that this is a general scenario. Please don't take it as an advice. If you want an advice, that will be that will have to be personalized to your own scenarios. So as in case of Varun scenario, that 15 years. So let's take that, and let's see. You are 45, and now you have 15 years to retire, and you want to maintain, considering your current monthly expenses are at 1 lakh rupees. This should not include any of the child's fees and education fees and tuition fees. This will only include your household expenses, because unless that is something that you are looking at, generally. So if you take that scenario only, so 8 crore is the requirement that you will have at 60 to survive and sustain your life till 95. And if you want to grow the investment, the monthly investment required will be 97,000 for this. Or let's see if we can change anything. Also, your risk profile will change. It will become moderate. Your monthly investment requirement is coming out to be 115,000, which is 1.1 lakh. And let's see if we can. Okay. I think this is so. This is what it looks like. But again, if you change the expenses, if instead of 1 lakh you say okay, just 50,000, so your scenario will change. Now you just need to save 60,000 rupees a month. Does that answer your question somewhat? I can understand it will not fully give you the idea, but for that you need personal financial plan. And based, as I said, the most of the work is figuring out the expenses that you will consider for the retirement. So that's a pretty detailed exercise itself. Great. Anyone else? So let me leave my contact details with you, and you can save. So this is uh, this is my contact number, and you can also drop me an email on this email ID with your scenarios and your questions, which I would love to address. Uh, so that's it from my side, guys. Thank you very much for joining, and hopefully you will also join the next webinar, which will be exactly uh, a month, 30 days from now, so like 27th or 28th January. We'll have to see the date. Mostly will be scheduled on the last Saturday of the month, so that you can all, most of the people can join. Thank you very much, Varun, for questions and all the others. Have a good day. Bye bye.